Issue number 4 would be on weighted average cost of capital. So weighted average cost of capital simply refers to the average costs when financing from the company's point of view from all types of investors. So you can borrow from the bank, you can issue bonds, you can issue preferred stocks, you can also issue shares, common shares, and an average of all of these investors would be WACC, weighted average cost of capital. All of these investors have different cost of capital. For example, cost of creditors would be much more smaller than cost of preferred stock shareholders. And, preferred stock shareholders have lower cost of capital compared to common stock shareholders. So we're going to do a weighted average of all of these costs of capital. And from now on, what we want to express is that we don't want to think from the company's point of view, but rather we should always now think from the investor's perspective, which is the average required rate of return. So from a company's point of view, it can be thought as a cost, but from the other side, from the investor's point of view, it is required rate of return. And a deal is made when these two parties agree on the rate. So usually these two can be expressed as equals. But now we have to think from the investor's point of view. So generally, a higher rate of return is required if there is more risk to the investment. So the more risk there are, the higher the required rate of return, and therefore the higher the weighted average cost of capital. So the higher the cost of capital. So when we're calculating or when we're thinking about weighted average cost of capital, always we want to think about the risks that are implied in investing to this company and the risks that are implied to investing in this specific instrument of assets. So weighted average cost of capital is there's going to be a ratio of debt times cost of debt. There's going to be a ratio of equity times cost of equity, ratio of preferred shares times cost of preferred shares. And these three ratios combined would equal 100%. Usually cost of debt is lower, cost of preferred shares is next, and then cost of equity is the highest. And one more thing worth noting is that for debt, always debt provides a tax shield, because the more interest rates, the more interest expenses that you pay to the investors, the lesser the tax rate, the lesser the tax expenses becomes, and that's called a tax rate. So debt is even much more, cheaper in general, but also in addition to that, it also provides a tax shield. So the more debt ratio there is, the lower the weighted average cost of capital would become, and generally that would lead to higher company value. How to calculate WACC in under 10 minutes? The quickest way to get the weighted average cost of capital if you're in a hurry is to refer to various equity research reports. This can be done especially if many analysts prefer to do a DCF analysis on your target company. And if you're really in a hurry, you can use that weighted average cost of capital. If you have access to Bloomberg, Capital IQ, or FactSet, if you have access to these kind of platforms, utilizing them would also be a very good way to calculate WACC very quickly. And also, these kind of sources can be also used even when you're doing, calculating weighted average cost of capital the traditional way. These can be used as benchmarks, or you can always compare your results with equity research reports and your results with these platform results. So always helpful to have these sources as backup. And digging a little bit deeper on weighted average cost of capital, we would now focus on these 3 points. Number 1, the capital structure. So which capital structure to use, how to calculate capital structure, and the impacts it has on weighted average cost of capital. Number 2, cost of debt. What cost of debt to use, how to calculate them in actual practice would be our number 2 focus. And lastly, and most importantly, the cost of equity, which is the most difficult to calculate and the most difficult to understand among these, factors. And of course, tax rate is also important, but usually tax rate is a given, thus we won't put in so much time into discussing about tax rates. So let's move on and let's start from the capital structure.